how can our business afford a commercial mortgage? Obviously, very important question. Our general rule of thumb, or when we're looking at opportunities that come through emilynow.ca or someone has asked us for our help, we tend to take their monthly lease payment and we sort of say, look, have you been able to make your monthly lease payment for the last couple of years or the last 5 years or the last 10 years? And if a business says, yeah, we've been able to do that, and then we're able to look at their financial statements and see that they have some net income, usually our general rule of thumb says, if you've been making money and you've been making your lease payments, then the amount of your lease payment is probably the amount that you could be using to pay for a mortgage. And so you take that monthly lease payment and you can do some math or use emilynow.ca and you can figure out, okay, well, if this is how much money we're spending in a lease every month, what would it look like if we were to get a mortgage? It's important to keep in mind that your business also has to have the cash or equity available as a down payment for the purchase price. But it's important to note, and most businesses don't realize this, but many banks will offer competitive financing options for a healthy business that has a track record, has history, has cash flow, has some retained earnings, and many times they're not even going to require any upfront cash to be used for a purchase. And maybe they might do something like, look, we'll buy the entire property for you, but now you can pay for the improvements to the property. Or maybe they'll say, look, we'll give you a mortgage to help buy the property, and then because cash flow is pretty important to your business and we can see that, but because you put so much cash through the bank, tell you what we'll do. We'll give you a mortgage and maybe amortize it over 15 years, and that little bit you're going to need for a down payment or equity, we'll give you a 5-year term loan for that. So between the loan and the mortgage, if that's even required, it can still be more cost effective than signing a 5 or a 10-year lease on a property that at the end of that period of time, maybe you're not going to have anything left to show for it. I mean, you got to use the property, obviously got to make some profit, generate some revenue, service some customers. But if you took that same amount of time knowing that you were going to have that cash flow or that lease obligation, maybe you could have turned that into equity, and at the end of 10 or 15 years, you now own an asset instead of having just rented it or used it. And of course, it's always important to know what your return on cash is. This is always a big argument for business owners when they're considering commercial real estate. They say, look, Dylan, if I had a couple of $100,000, I get a better return just pumping it back into my business than I do tying it up in a piece of real estate. And that's true. But what if the real estate didn't cost you anything? What if you didn't have to put a couple of $100,000 into the real estate? Well, then that kind of changes everything, because if you didn't have to put any cash into the real estate, the bank was able to lend you that money, but they were able to do it at lower rates than what the mortgage payment compared to the lease payment. Mortgage payment is less. What if they were able to do that? Well, now you're kind of looking at a bit of a different decision. Commercial mortgages, it's important to know, are shorter than residential mortgages. So it's not typical that you would get a 25-year commercial mortgage, or that you'd probably even want one. You probably get a 15-year, maybe 20 years, but 15 years is probably what you should budget for. And so if you think about it, you didn't put any cash in, really low interest rates, within 15 years you've bought an asset, it could make sense for your business. I'm not saying that it always does, but it could make sense. You're also going to want to know, when you're trying to determine, how does our business know if we can afford to do this? Well, there's some additional costs that are involved in commercial real estate. There's appraisals, there's environmental reports, structural reports, mechanical reports. Basically, there's a bunch of due diligence that you have to do when you buy a commercial property, and there's costs associated with that due diligence. And so they're not huge costs, but they are costs that can run the tens of thousands of dollars, and so you would need to have at least that kind of money available to make a purchase. The first step to understanding how you can afford a commercial, if your business can afford a commercial mortgage, is actually to determine the why. Why is it that our business wants to buy this commercial property? Is it cash flow reasons, investment reasons, future growth reasons? We just need kind of more space and we want to know that we have it. So once you've done that, then the next step is to understand the math. How much are you leasing right now? What are your leasing costs? And if that was converted into a mortgage, what would that look like? And then obviously the last step is to visit emilynow.ca, take the first 2 steps, and now start to work through the process of putting the rest of the pieces together. At emilynow.ca, if you've never used it before, You can create an account, get a score for your business out of 10. It's really simple. And based on that score out of 10, you can then take a look into the lender marketplace. There's hundreds and hundreds of lenders in the Canadian market who we have scored for you as well. So you can take your Emily score, match it against the score of these banks and lenders, and really get a handle on what your options would be. So if that works for you, check it out at emilynow.ca, and hopefully this has given you a little bit of insight into how you can begin to think through, can our business, or how does our business afford a commercial mortgage?